Hello, and welcome to our second video in our three-part series where we talk about CSP's retirement strategy and how we build investment strategies for people's superannuation to see them through their retirement. In our first video, we spoke about the conundrum that a lot of people face when they move into retirement, and that is, what do they do with their superannuation? How do you invest your superannuation in such a way that you can get a reasonable return? You sort of need 5, 6, 7% or so in order for your money to last you a long time, but not expose that portfolio to any risk. If a share market crash happens and your money's in the share market, you don't have any more time left. You can't recover. And that's the conundrum a lot of our clients face. The secret to unlocking this conundrum is you need to change the way in which you think about your superannuation. If you think about your superannuation, let's just say you've got $1 million of superannuation and you want to draw a $50,000 a year income stream. If you think about it as one homogenous pot of $1 million, I should say, you can't unlock the conundrum because you can't afford to take the risk with the $1 million, but you need to invest the $1 million because you need the return. It can't be unlocked. The trick to unlocking it is not to think about it as a pot of $1 million, is to think about it as a series of $50,000 income payments. It's $50,000 this year, $50,000 next year, $50,000 the year after, off into retirement. And when you do this, you can now start to unwind the conundrum, because the $50,000 lump of money that you need next year to live on, for your living expenses, you clearly can't afford to put that in the share market. If the share market crashes, there's no guarantee at all that it's going to have recovered within 12 months. So you need to have that $50,000 stashed away in something really low risk, low return. But the $50,000 lump that you don't need for 15 or 20 years, that is a long time for equity markets to recover. I would suggest that you can definitely afford to take risk with that part of the portfolio that's funding the really long-term assets. So if you break into a series of income payments, the short-term stuff we can't afford to take risk with, but the long-term stuff we definitely can. What we're really doing here is we're breaking the money into a series of payments, and then we're just aligning when we need that pot of money with the risk that we're exposing that pot of money to. That's really all we're doing. But if you think about it as a series of payments, it becomes much easier to do. Now, at CSP, we refer to this as our bucket strategy, and we have 3 buckets within our portfolios. The first bucket, bucket 1, is your low risk, low return bucket. This includes things like term deposits, cash, very short dated bonds, so things that really aren't very particularly volatile. Unfortunately, they don't give you very much return, but they are very, very, very secure. Now, back on our example, if we've got $1 million and we want somebody wants $50,000 a year of income out of that, we might put, for the sake of illustration, say 4 years worth of income into bucket 1. So 4 years of $50,000 is $200,000. So $200,000 gets stashed away in very low risk, unfortunately low return, but low risk type assets, because that's our short-term money needs. Now, some clients have more than 4 years, some have less than 2 years. Don't worry for the moment about the size of the bucket. It's the principle at this stage that matters. So your short-term money is locked away. You then have what we call bucket 2, which are our alternative assets. And bucket 2 has generally another 4 years worth of income in it again. These are investments where we can afford to take a little bit more risk because we don't need them for the medium term, and we're hopeful of getting more return than we are of cash, although certainly not pushing it as far as shares. For us, this includes things like infrastructure, some certain types of hedge funds, managed futures type funds. They're a little bit more complicated, this one, so we can talk you through it when you come to see us. But just for the purpose of this, they're alternative assets, a little bit more return and a little bit more risk than cash, but definitely less than shares. And as we said, average client might have another 4 years worth of income, so 4 years in bucket 1 and 4 years in bucket 2, gives us 8 years worth of income in total. We've then got bucket 3, which is the remainder. We've got $1 million, we've got 4 years or $200,000 in bucket 1, we've done another $200,000 in bucket 2, that leaves $600,000 that we can put into bucket 3, which is essentially our shares bucket. Yeah. Bearing in mind, we don't need that money for 8 years from when we first start off the program. As I said, some clients want more, some want less. We can tailor the size of the buckets and talk you through the consequences of that when you come and see us. But the principle here is the really important thing that matters. So the really critical question is 8 years enough time for the share market to recover? It's a really important question. And we can actually, if we go to a graph of the share market, we can actually see that, yes, it actually is quite a reasonable period of time. What we've got here is our share market graph from video 1 that shows the share market, the equity market volatility and the major falls. However, what we want to look at this time is, instead of how far it falls, we want to look at how long it takes to recover. And you can see from this graph, where we've overlaid the red line, that there's really only been since 1980 two material periods of time where it's taken sort of more than 2 or 3 years for the market to recover. And that was right at the peak of the 87 crash and the GFC that's just gone past us. So you can see the GFC was the longest it's ever taken to recover a previous high. It took 6 years. If you invested the day before the crash in 1987, it took you 5 3/4 years. Everything else, it took 2 2/3 of a year in the early 80s with the major recession we had, and everything else on this graph is less than 2 years, and that's 36, 37 years worth of data. So, nothing's guaranteed in the investment world, as I'm sure all of you know, but I think if you set yourself up with your portfolio with 8 years of protection, it's got to be 33% worse than it's been ever since 1980 in order for you to get caught in a negative position. So, as I said, nothing's guaranteed, but I think this is a pretty reasonable basis to make an investment decision. So, just in summary, the trick to solving the conundrum is not to look at your superannuation as one big homogenous pot of capital. It's to look at it as a series of $50,000 series of income payments, and then all you're really doing is matching when you need those income payments with the risk you're exposing those income payments to. So, join us for our third video where we take this discussion out of the hypothetical and show you how we actually do it at CSP and what our actual processes look like. We'll see you soon.